Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's probably going to be related to three topics: commodities, financial markets, and or wealth building topics. Those are the three that I generally cover. I'm going to sprinkle in my financial opinion as we go through it. And let's dive in there and see what people are talking about over the weekend. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, we do have a discount going on called Holidays. It's in the description link below if you'd like to join for individual sectors, individual companies that I talk about. So JC Parrots, he says, we just saw near 52-week lows this week for gold relative to the NASDAQ. Does gold still need to retest those 2000 lows, or have gold investors already suffered through enough opportunity cost? And this is a ratio chart of gold versus the NASDAQ 100. Do you think it's actually going to come back and go all the way down to the bottom here? It's possible. I'm not saying it can't. It kind of almost looks likely that that potentially could happen. So maybe we do get a blow off top in the NASDAQ. It comes down and tags this, and then gold does its revaluation just massively against the NASDAQ. But that is a possibility. I'm not saying it can't be or it won't be, but it is a possibility. Run down. It says, if you limit your buying to the green circle, you are setting yourself up for the biggest upside while protecting major downside. And this is the stage analysis, stage 1, 2, 3, 4, and 5. Generally in stage 1 down here, either side, you get a pattern, a double bottom pattern, an inverted head and shoulders, etc., etc., etc. On the website, we are buying a lot of what's in the green circle. There are some things that are lagging behind that are in stage 1 still. They're in the right-hand shoulder of an inverted head and shoulders. So if you were to look, maybe your exploration production companies, some of them could be up here, some of them are still down here, and some of the energy service companies are still down here, while other energy service companies have made it out of their basing patterns and are in the green circle. So that's exactly where we're entering our investments at the current time. It's a mixture between stage 1 and stage 2. It's considered to be the ideal entry point from a technical analysis standpoint. Now, that's where I enter, and some of them I entered early stage 1 based off of the ratios, and it just you have to wait longer for that to work for you. Some people say, well, it's an opportunity cost. Not when it's an inverted head and shoulders, and the head of the inverted head and shoulders is a 10 or 20 bagger. And this is what's to come, is a big move in stage 2. From a time perspective, the green circle is definitely the best time to buy. And from a risk reward perspective, it is also a very good time to buy. That's what I'll say there. Compounding quality, I wanted to go over these. He says returns over the past 200 years, stocks, bonds, bills, gold, and dollar. And the only thing I'll say here is I don't think you can show this before 1970. It's an unfair comparison. Stocks did very well during that time frame from 1800 to 1971, but gold and the dollar were linked together and we were on a gold standard. So I find it highly unfair to show this the way that they have it. Now, if you were to take this from 1971 onward, I bet you stocks and gold would be fairly close. And then if you were to take gold from 1980 or 98, or from 1998, it would look even more different. Gold would be beating stocks. And gold would also be waxing bills and bonds because this wasn't fixed after 1971. So I think it's a little bit misleading, this chart. Investors are their own worst enemy. So the S&P 500's returned 9.5% And then they used a 20-year annualized returns by asset class. So it's a little bit different mix there. Notice that they don't have gold on there. Gold from 2000 onward has actually outperformed all of those. I think it's all those asset classes, I think. But they've got commodities here, 1.8%. They're definitely lagging inflation down here. But I like what's on the right-hand side, commodities, because I think that's what's going to outperform during the next 10-year cycle. The average investor has not beat the S&P 500. Start investing as soon as possible. Investor one starts at 25, sets aside $5,000 a year for 10 years in a row. No more investments after age 34. This person, investor two, starts at 35, invests $5,000 each year for 30 years in a row until reaching age 65. The power of compounding carried the investor one to a higher level than investor two, even though investor two put in far more money of their own money. So compounding works based off of being in the investment longer. You get a greater benefit of compounding the longer you're in it. So time in an investment is better than less time in an investment if you can get compounding to work for you. Invest for the long term, total real market returns 1871 to 2012. It says you get to hang out over here. So this is the percent of periods that earned a positive return. And you can see if you hang out with the time in the market, 10 years in the market, you have an 88%. It says percent of periods that earned a positive return. 88% of the time it earned a positive return. 95%. 20 and 30 years, you had 100% of the time you had a positive return. The power of compounding, obviously, if you start with a penny and double it every day, for 30 days, you have 5 million at the end of starting with a penny, if you double it every single day. Investor psychology, this is true though. If you have a stable investment that goes from 10 to 20, the person's really happy. But if you go from 10 to 30 to 20, this person's miserable and thinks that they've lost all this potential profit and return. And all it is a psychological difference between the two. Investing is really difficult to time the exact top. So I think trying to get the exact top, it just doesn't work. And you have to configure your brain to be more like this first person, even if you get a decline in the price. Percentage gains needed to recover from a loss. This is kind of crazy. 70% loss, you need a 233% gain. But it depends on when you buy something and what you're holding it for. If you're in some of these really volatile stocks, it is very easy to go down 40, 50%. 50% is 100% gain. And people will be like, well, you need 100% gain. Yeah, but what if your upside's 1,000% or 3,000%? That is completely different than what is shown in this chart. This is just a chart showing what it would take to get back basically to your break-even point. And that's why you always choose massive symmetry in your favor, where your downside might be minus 50, but your upside could be 1,000% or 3,000% or 10,000%. That's the lopsidedness that you're looking for. The cycle of market emotions, the market's up, buy everything, I want all in. And that's what people think. The market is down, sell everything, I want all out. And that's the emotions that people have. And this is the difference. A successful investor, it says, recognize this is the point of maximum financial risk. And then here it says, a successful investor recognizes that this is the point of maximum financial opportunity. So basically, if you're an experienced investor, you may not have the strong emotional pairing with the down move, but you have to realize that that's what the majority of the other market feels and is going through. 9, investing isn't gambling. Odds of losing money over a 15-year time horizon, 0.2%. Your time frame is what determines the odds of losing money. And what do I always do? I hedge myself with time. Oh, I'll wait longer. If I wait longer, my odds of success are better. Makes sense? There will always be a reason to sell, reasons to sell, and he's got all these different reasons of what to sell. And if you just held from 2009 all the way to 2019, it's a 500% gain. Coming on back, $6 trillion parked in money market funds will not stay there forever. Where will it go? And that's that money rotation. We have 6 trillion parked in money market funds. That is ridiculous. 6 trillion. Wow. Breaking, the average home payment for a home buyer hits a record $3,322 a month. Meanwhile, the average cost to rent a home is a record $2,184 a month. It is now less affordable than any time in history to buy a home in the US. This is a crisis. It's because we don't have enough homes for renting and or for buying. Either one. Coming down, the current yield curve inversion reached the same depth as 1928. Let that sink in. And I don't know if the depth matters. I think it just matters that it inverts. So it inverts and uninverts, and then you get a recession. So I don't know if the depth of it determines the move to the downside. I don't think that's right. So I don't think the depth really matters. I was just looking at that. What happens if this trend reverses? More oil rigs from fewer rigs. U.S. oil output has soared while drilling has declined. So he's speculating, what happens if you get less barrels per day versus your rigs that you're putting into it? That would be peak oil. I don't know if that will be the case. It looks kind of interesting here. Let me copy this image real quick. I just want to do something just for the heck of it. Paste it here. I'm just going to do it right in front of you guys. Is there kind of like a trend here? Do you see that? It looks like to me that this is one hump, two hump, third hump, a breakout, a pullback. This looks good to go higher. Like I'm not drawing it. It's not like Trading View. This to me looks like a falling wedge that's broken to the upside and it's ready to go on up. So I think we're probably going to see more rigs, not fewer rigs out in the future. That's my guess, based off of the chart pattern that is created in your drilling rigs number. BTC versus Amazon, similar fractal in Amazon in the 2000s and Bitcoin 2015. Now, the only thing I would say here that's different than what I see is number one isn't in the right location. I think number one is here. This move here is that move there. And then you go into 2, 3. That's the only thing I'll say because one should be moved over here. So one is here. This fractal is this fractal there. And then you go up to 2, 3. And then a potential move lower. I don't know. We'll see. And that's in Bitcoin. Alan Corey says how interest rates affect house prices. House on the market for 100 days, 42 showings, no offers. Interest rates drop into sixes. House immediately gets 3 over asking offers in one day, one over 50,000 plus over the asking price. Yeah, that's crazy. Small cap stocks could explode higher by 50% over the next 12 months, says Tom Lee. The Wall Street bull who called this year's stock market rally says small cap stocks could surge 50% over the next year. What do you guys think? I don't know. That's what he thinks. Here's uranium, the CCJ to M2 money supply, and mega uranium. It says mega uranium in the last cycle did not move until the last month of the second leg up. Similar lag in other small names. Patience is key in my opinion. What's happening is not unusual. So what he's showing is he's showing This is basically a 3-wave up move, or I should say a 5-wave. It's 3 up move waves and 2 pullbacks. It says Mega Uranium didn't start moving until the end of the second leg, which is basically where he's got this line going across here. And that's where the box in the box is. So again, some of the junior companies that haven't moved, it's normal. It is normal that it hasn't moved yet. It's nothing out of the ordinary. Be patient, guys. Everybody be patient. This is IWM, the small caps versus the large caps. This is probably what this fund manager is seeing. He's probably calling for an outperformance here because of the bottom that it created. And this here is a slingshot cheetah pattern. It comes down and it pulls back like a slingshot pulls back. And then the rubber band lets go when all the short sellers get squeezed out of it. So small caps versus large caps, we could see an outperformance of small caps here. And this doesn't look recessionary to me. It really doesn't. I know I've said some things like, maybe there is a recession coming, but some of this data does not look recessionary to me. And this is one of the pieces that does not look recessionary to me. There's still a ton of speculation out there that falling mortgage rates in 2024 might lead to a flood of sellers and therefore a price crash. The data is very clear, and the opposite is true. Lower rates stimulates demand more than supply. Inventory falls with rates. Says, this is how I illustrate the data below. And the current inventory here, and he thinks that demand will be impacted more. I agree with that. And that's what we saw above. It's going to impact the demand and the ability for first-time homebuyers to get into the market. We showed a longer-term chart. I think it was like a year chart where palladium was the worst performer over the year. And I'd say, hey, you know what? The two that I would be looking at is coal and palladium. 1 week performance, palladium up 25%. Nailed it. Sorry, just had to say that. Coal here, it doesn't look like we have coal on here. I don't see coal on this chart here. So I don't see where coal's at, but coal would be another one that I would go long at. I would not be going, even though it was like a worst performer in a year, it's something that I think will go up. Uranium and Commodities Watcher, this is this guy's portfolio. And I just was reading through this. And this is very hot. This is kind of a general retail investor's portfolio. And when I look at this, I look at the risk that this person is taking. It's a lot. It's pretty risky here, guys. I mean, Uranium Junior Explorer, Uranium Developer. I think this is a Silver Explorer, Uranium Developer, Silver Producer, Silver. I think Abra is like a developer / explorer. Wheaton Precious Metals is a royalty company. Anfield Energy, small little uranium developer. UR Energy, uranium developer producer. Southern Silver, which is a uranium exploration company, I think. I mean, this has got a lot of risk. So I just wanted to show that, not that I'm knocking this guy's portfolio. I'm just saying it's risky. I mean, maybe it'll work out for him, but I wouldn't take on that much risk. That's just me. Specs reduced their net length by 60 million barrels this week. That's almost 9 billion. That's almost 9 million barrels per day of extra supply, all supplied by financial bros who are playing for a recession. Meanwhile, Jay Powell just told you that he's going to run it hot. Whose team do you want to bet on? So the guys are selling their length in the speculative oil positions. Jay Powell says he's going to run it hot, and maybe I don't know what the reason is that Jay Powell's doing this. I don't know why he's doing this gigantic turn of events where he's lowering rates. It could be positive for the markets, and it could send everything to the moon. It could be politically driven, and I'm sure that's probably the case. Or he sees something in the market that is potentially a problem. But I just don't see the setup in stocks and in oil and a lot of these commodities. They don't look like they want to go down necessarily. So it makes me think that Cuppy's probably right here that they're going to run it hot and it's going to go up a lot across the board. And oil is going to be one that goes up with it if they do that. It's going to be inflationary. There's another thing I wanted to talk about here, guys. I wanted to read some of these quotes. The quotes, it says, don't try to time the market. 15 most funny yet insightful quotes from famous investors. I'll zoom in here, get it as big as I can for you guys. It says, a trader needs to be highly skilled and extremely lucky to beat the market consistently. If a trader is highly skilled but not lucky enough, or extremely lucky but modestly skilled, he will beat the market occasionally but not consistently. Traders that are modestly skilled and modestly lucky will briefly beat the market, but will be behind the market most of the time. Everybody else will lose money on a long-term basis. That is 90% of the traders. So the majority of traders, they're going to lose money. And if you day trade, I mean, those guys almost always lose. It's like 99%, 99.99% lose trying to day trade. Here are my most favorite 15 quotes. It says, and we should not be trying to time the market. There are only two types of people when it comes to market timing. One, people who cannot do it, and two, people who have not realized that they cannot do it. The idea that a bell rings to signal when investors should get into or out of the stock market is simply not credible, says John Bogle. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves, from Peter Lynch. Only liars manage to always be out during bad times and in during good times. Only liars, boys. Our stay put behavior reflects our view that the stock market serves as a relocation center at which money is moved from the active to the patient. So all those people that are being incredibly patient, they're taking the money from those that are active. It's a money transfer. Do you want to be part of the active, or do you want to be part of the patient? You don't need to beat the market, do over leveraging, or pick the best stock to be rich. You just need to earn a decent rate of return and let your money compound over time. We continue to make more money when snoring than when active. Patience, patience, patience. Whenever some analyst seems to know what they're talking about, remember that pigs will fly before he'll ever release a full list of his past forecasts, including the bloopers. Predicting a downturn is not critical. The important thing is, what do you do when a significant downturn happens? The average investor's return is significantly lower than market indices due primarily to market timing. I do not know of anybody who has done it successfully and consistently. I don't even know anybody who knows anybody who has done it successfully and consistently, which means market timing, from John Bogle. He was a multi-billionaire that started Vanguard, if you wanted to know. We have long felt that the only value of stock forecasters is to make fortune tellers look good, Warren Buffett. Market timing recommendations have an impressive track record of being harmful to an investor's financial health. It's a staple of personal finance advice: buy and hold, because trading the stock market is a sucker's bet. The odds that you will achieve long-term success by actively trading or timing the market round to zero, says Morgan Housel. So that's what we've got for today. I just kind of wanted to go over those last few quotes. My strategy doesn't require market timing. It's very much in line with Peter Lynch and Warren Buffett. I took the cue from a lot of their books and sayings and implemented it into the strategies that I deploy. And you know, mine is the three market. It's technical analysis, ratios, and market conditions. The fundamentals is really what drives it's playing the business cycle. That's the market condition. That's really what it is. And if you can identify objectively what's cheap and what's expensive, it gives you an edge because you know how to value those sectors. And then if you compare that with the real estate cycle, then it gets you in the ballpark of your timing. It's not going to be perfect. It's just ballpark. And then you can use technical analysis to try to further increase your odds of success. It's not about making predictions in the market. It's about identifying the value and getting a somewhat close entry point to where it could potentially shift based off of a changing of market conditions. And that's all you can do. I don't think there's anything where you can pinpoint this stuff and buy an undervalued sector, ride it up, buy another undervalued sector, ride it up in a short-term time frame. I don't think it's possible. Your time frame has to be long, and it gets you in the ballpark of when it could potentially go. So your time frames have to be long. And if you notice, a lot of the stuff that we went over today is lengthening your time frame, your probability of making money goes up. Market timing, all the greats that I just read all those quotes from, they say don't try to market time. So what am I trying to do? I'm not trying to market time. I'm trying to time my investments into things where they are cheap and that they could potentially be turning and moving on up. But you have to hedge yourself with time. That's exactly what I do. I don't put leverage into it because leverage then requires you to time it. If you put margin on it, it requires you to time your investment because if it goes down, you can lose money and you may get margin calls and etc. Options are a form of timing your investment. You're saying it's going to go up in this specific period of time, and it has to go up a certain amount for you to actually make money. Incredibly difficult to do. So the way that I've done it over the years, no leverage, don't play options, don't try to get too crazy with stuff. Get the symmetry in your favor, big, huge upside rewards, reduce your risk where you buy it where things are down. You're still going to get volatility. You're still could be down 30, 40, 50% in your investment, even though you bought it way down there. And then you hedge yourself with time. And then you wait. And then you spread yourself across 4, 5, 6, 7 different sectors that are all really, really good values. You may not buy them all at the same time. You may accumulate them over the years. And then when they become overvalued, after you make your 10, 20 times your money, you sell it, or 5 times or 6 times, whatever it is. You sell it when it becomes overvalued and you switch it to the undervalued asset class. Some of those sectors are going to do absolutely ridiculous things for you if you choose the right sectors that have the symmetry in your favor. You may even get a 100-bagger. What does a 100-bagger feel like? You put 10 grand in it, you get $1 million back. That's what a 100-bagger feels like. Not many people that I know have had any 100-baggers. I don't know of any outside of, I haven't had a 100-bagger yet either. I'm trying, guys. I've had 20 baggers and 30 something baggers. I think is my most. I've never had a 100-bagger. Some people have gotten 1,000 times their money. That is ridiculous. And there's some companies. I'll show you a company here just so you guys know. AMR. I think it's AMR. I'm gonna zoom it out here. I think AMR has gone up. Yeah, Alpha. Look at this. Look at this. Look at this, guys. Look at this thing go. Holy crap. So from the bottom of 2020, this is from the bottom of 2020. Oh my goodness. It has gone up 16,000%. That's 161 bagger. Oh my God. 161 times. And that is just ridiculous. They must have a lot of debt. They probably were real close to bankruptcy or something that happened there. That's my guess. But 161 times. That's just, I had to show you guys that. Sorry. In only a few year, or what is that, 3-4 year time frame? That is ridiculous, guys. So ridiculous. So if you take these big asymmetric bets, it is definitely possible. I just use that one as an example. That's a metallurgical coal company, met coal. So that's what I've got for today, guys. I think those 20, 30 baggers are out there. I think they're attainable. And that's what we try to look for in the finding-value.com website. That's where I'm looking and I'm sharing those potential picks. So give me a thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.